You could not live with your own failure. Where did that bring you? Back to me.
Rich people buy real estate. Real estate does not make you rich. Just because you invested in a rental property or a room to Airbnb or a piece of land to build a house for rent, that does not mean you have graduated to the Champions League of wealth creation. Real estate in Trinidad isn't some all-powerful snap your fingers and get rich investment tool. There is only one single thing that matters when it comes to deciding if investing in real estate is worth it. In this video, I am cutting through all the Robert Kiyosaki noise. I am letting you know the truth in how to become successful with rental properties. Let's dive in. Hi folks, welcome back to my channel where we talk about investing in the Trinidad and Tobago stock market for the sole purpose of financial independence. So as we normally do, I give a brief overview of where my portfolio is at. Currently, the value of my portfolio is at $513,417. I have a current annual return of 5.9%. And for the purposes of this video, since this video is a special one, I am going to give you what is the estimated annual dividend yield of my portfolio, which currently is estimated to be 5.45%. This value is calculated based on the amount of dividends I'm getting for this year. This is the estimate. The sum of all these dividends divided by the value of my portfolio that I paid, the cost price, not the current value price, the cost price of my portfolio. So it's the dividend collected for that year over the cost of my portfolio. And of course, multiply by 100, and that will give me the annual dividend yield or the estimated annual dividend yield. So we're going to work with this figure, 5.45%. Today is a big one as we're going to talk about investing in real estate. And just as in stocks, you are investing in real estate to get a return on your investment. Additionally, similarly with stocks, as I will remind you, the returns of investment has two components. For stocks, it's the capital gains and the cash flow, your dividend yield. In a similar way, the return of your investment in real estate has two components. So as you can see here, the total return on investment, or otherwise known as the internal rate of return, IRR, of real estate is the sum of the real estate appreciation, which is the value of the real estate going up over time. So if you pay X for a particular piece of real estate and you sell it for Y, then Y minus X is your profit. And this is called appreciation. So that's part of the return. But additionally, when we talk about when you're renting real estate or you're getting a cash flow from leasing or renting real estate, or if you're using Airbnb or anything along those lines, you're getting a monthly cash flow. And this cash flow is your rental yield. And this also is a component of your return because it will be your annual yield, rental yield on that piece of real estate, plus the appreciation when you do finally decide to sell that property. When you aggregate it over the time period, you get your internal rate of return. And thankfully, There are calculators for this on the internet, and I will show you that a bit later down in this video. But when it comes to real estate, investing in real estate, we are all thinking about rental properties. So I'm going to keep this video simple and straightforward. We are talking about investing in a property to rent. And the first question is, well, if I'm getting a rent of X, then is this investment that I'm making worth it? And I will show you later on all the costs associated with calculating the rental yield, but just from a big picture approach, what you're looking for is that rental yield. That is what really determines whether a property is worth it or not. There is another strategy when it comes to real estate investing, and I'll briefly touch on it. On the internet, they are known as flippers, where they buy a piece of real estate. Maybe it's in a dilapidated condition, so it's selling at a low price. They buy it, they fix it up, and then they sell it. They don't rent, they sell it out for a profit. They are called flippers. A lot of people can get rich with that. In Trinidad, not so much because any piece of real estate in Trinidad sells at a very large premium. However, we do have our own version of flipping, and well, let me give you a visual example. This is a real estate flipping Trini style. So let me just sort of zoom in here. So we just recently had a new, well, there was a new segment of highway that was built under the last administration. This is a portion of the new highway in Sandy Grande. And let me just zoom out so you can get where I am. Okay, let me zoom back in. So based on the data I saw, it's going to sort of come, well, this is a part they built. I think there will be a component that sort of goes around Grande, and wait, let me see. There is a Toko road. Where is that road? Yes, this is the road here. So it will, from this area, there will be another segment that sort of goes around Grande and ends up at this point, and then they're going to upgrade the Eastern Main Road. So why am I showing you this? Let me just zoom in a bit on. Let me zoom in on this end. This end is a good, yes. Let me zoom in on these houses here. So let's just say 10 years ago, before the whole idea of this highway came to pass, I wanted to purchase this piece of property here, which basically is in the middle of nowhere. It's in the back of Waterfield. It's in the back of Waterfield racetrack. So it's in the middle of nowhere, basically. So let's say I wanted to purchase this piece of property here. Whatever price this was, is going to be much lower than it is today. And this is flipping Trini style. The reason why this property would appreciate now is because it's in such close proximity to the new highway. This new highway, I think, is going to turn up this way. I think somewhere on this side, it will continue going upwards. So all the properties in this area will appreciate in value. So Trini style is if you have a link in the Ministry of Planning or you have insider information in the particular administration that's in power and they approve this highway, you find that quickly people will buy up all the available property around this value, this area. So when fast forward 5 years, when they finally build the highway, they then try to sell the property. So this is what it's called flipping Trini style, right? You buy it low because you know, but you buy it in an area that you know there is upcoming development. You buy it low before that becomes public information, and then you sell it. And you know, there has been accusations in both PNM and UNC administrations of ministers doing this activity. But from a financial point of view, this is what they're really doing. They're capitalizing on the returns of real estate appreciation. And 5 years, even 10 years, that's From a real estate point of view, that's a short space of time. Okay, let me get on to the real business of rental yield or returns from your rent. Your rental yield is basically your net returns from renting your piece of real estate. This value is developed from taking your annual rent payment, your annual gross rent, minus your ongoing operational expenses for that year, and the figure is then divided by the cost of acquiring the property. This value is otherwise known as your cash on cash return. And this is the main metric for whether investing in your property is worth it or not. So let me break this down a bit further. In terms of your initial acquisition, similarly with your house, of course, you have the purchase price, which basically is the price tag on a piece of apartment or piece of real estate. You have your renovation costs. Perhaps the property will need some renovating in order to make it rent ready and to bring it up to the standards to which you can rent that apartment or house. It may need some fixing, or you may want to add some appliances. Let's say you don't want to sell it you don't want to rent it semi-furnished or furnished. So you may need to add some appliances. So all that is the initial cost. Also, part of acquiring rental properties, you may have some inspection fees. Of course, you will have some legal fees. You will also need to pay your real estate agent. So all of these fees that are associated with acquiring the property, that's part of the initial acquisition fees. Also, in most cases, you aren't going to just pony up cash to purchase this property. Most likely, you're going to mortgage. You're going to go to the bank, borrow some money. You may have some money you want to add to it, and the total of it you're going to pay to purchase that property. But of course, if you mortgage, if you go to the bank for a loan, you're going to have to pay back the bank over time. And as you saw with buying your house, a lot of the component of that money that you're paying to the bank initially goes to just interest. The bank has to make their money. But from an investment point of view, you have a payment to be made every month to the bank. So, of course, it would just make sense that your rent should be more than the mortgage payment. And that's why people say rent money is dead money, because your rent is going to help pay the landlord's mortgage. And that's true. If it didn't help pay the landlord mortgage, then it wouldn't make sense to be a landlord. Okay? So we move on to the operating costs. So one of the big operating costs is that mortgage payment. Additionally, there may be property tax. I know the current administration is saying that they're going to scrap property tax, but we're talking about decades, 2 decades you'll be renting this property, and we don't know what will happen in the next election. So you must always factor in property taxes as part of the operating expenses of your rental property. Definitely, you will have insurance from fire, insurance from theft. You're going to need to insure your property. Of course, there will be maintenance. Maintenance is key for you to run a successful rental property business, because no one will stay in a dilapidated house. And it's different from your shelter. So, for example, if you have a tap in your home, sometimes, the tap wouldn't really open properly the way it is, but it still functions. It still shuts off the water. It still opens up. But it doesn't function exactly like how it was when it was brand new. Because it's your home, it's your home, so you will settle for that. But renters want to see everything fully functional. If it's not fully functional, there will be complaints. So that's why maintenance costs of a rental property tend to be high, almost 10% actually. You must budget 10% of your gross income. And from my own experience, what happens is you'll have periods where there's nothing to do. And then all of a sudden, you have leaks, you have holes, you have paint jobs, you have all sorts of things that needs fixing. Another key operational cost is your management fee. And this could be somewhat controversial because a lot of people they don't take this cost into consideration because maybe they are their own property manager. But it's still a cost to you whether you're the property manager or someone else. Now, ideally, if you are investing in a property, you want to maintain that role of investor and not manager. Because once you start managing, it now takes time and effort from you. And there's a cost attached to it. So typically, the management fee cost is around 10%. It varies, but 10% is a good value. 10% of the gross monthly income is a good value to assign to management fee because no one really wants to deal with tenant complaints, issues with your tenant at all hours in the night or when you're on vacation. If you're looking to invest in real estate, you're looking at to be a passive investor. So you're going to pay someone else, a property manager, to manage your rental. And this is just another additional cost to renting this property. So this must be taken into consideration as well. Also, part of your costs is vacancy costs. Now, you can't always assume that all of the 12 months of the year you are going to have someone in your property. It's especially relevant when you're using Airbnb. Airbnb has their peak periods and their uh, low periods. Like, say, for example, around carnival time. Around carnival time, there's no places, there's no vacant places for rent from an Airbnb point of view. Whereas, let's say around, let's say summertime, no one's around, there's always places to rent, right? So you have to factor in those operating costs. So it's not necessarily your income will be 12 by your rent. You may want to factor in a percentage, maybe 10% of your gross rent as a vacancy cost. And so collectively, these are your operating expenses. And of course, you have your initial renovation costs. So now that you have your costs and you know your rental value, you can now calculate your cash on cash returns. This is a final equation to calculate your cash on cash return, which is usually expressed as a percentage. So what you have here is your gross annual rent income. This is basically your monthly rent multiplied by 12. And that's what you're earning from renting your property. And of course, you must minus all your operating costs and expenses that we just spoke about. That is your maintenance fees. This is your vacancy costs. This is your property manager fees. This is your mortgage payments. You minus your annual cost from your gross annual rent income. And then you divide the value you get by the initial acquisition cost. This is the cost of acquiring the property and the costs, all the costs associated with getting that property up to the standard for renting. And the result of all of this is your cash on cash return. And this is what we will determine whether the property is a good investment or not. Now, let me ask you a serious question. If this value here is 6%, let's say you get 6% when you do all your costs and your calculations, is that a good return on your investment? Maybe it sounds good in isolation. You're getting 6%. Maybe that sounds good. But I just showed you my portfolio was 5.45%. So you might think, well, yeah, it's better. It's 6%, and my portfolio was yielding 5.5%, 5.45% dividends. So, of course, investing in real estate was better. But is that really? We just went through all the effort that it took to get a property ready to be accepting tenants. And then you have to manage that, whether it's you managing it yourself or whether it's a property manager. Because at the end of the day, you still have to manage your property manager, right? You still have the final say in any decisions in terms of any sort of big maintenance that needs to be done. Is that worth the effort if this value is 6%? I don't think so. So that means that when you invest into real estate, you want this value to be much bigger than any other investment options that you might have on the table. In particular, you want this value, your cash on cash return, to be much larger than, let's say, an alternative like investing in the Trinidad and Tobago stock market. Because if it isn't, you might as well just relax, invest in the Trinidad and Tobago stock market, and chill. Because remember, imagine you are going out to get a loan to do this stuff in order to get this cash on cash return. And a lot of things are just estimated cost because things go wrong. You could have bad tenants. You could have overlooked something during the inspection of the apartment or the house that you were buying, and you only realize that the costs of getting this apartment or house to a quality level where it will be able to rent is so much that your final cash on cash return isn't worth it. That's a lot of effort. So then, how do you know whether it's worth it? This value must be obviously so much greater than any other potential investment opportunities. So, what is that value? Let me tell you. You don't need to know the details of the operating expenses. You don't need to know the details of what manager fees and all that stuff. You don't need to know the details of the location of the property. You don't need to know the details of whether you need an inspector to inspect your property. You don't need to know all those details. All you really need to know is two values. You want to know what those values are? I will tell you. All you need to know is what's the gross income potential of that property and what is the price of that property. Let me repeat. All you need to know is two values. What is the gross income value of that property and what is the price of that property? Because with those two values, you can get a gross cash on cash return. It's gross because you haven't factored in all of the expenses. And you probably will have to buy equipment or renovate the property. But just the listed value is enough. Because once you have those two values, you can get a gross cash on cash return. But the kicker is what value you're looking for. You are looking for 15 plus percent gross cash on cash return. Anything more than 15% is an excellent buy. Anything less doesn't make sense. Let me repeat. Your gross cash on cash return must be 15% or more, even for you to think about investing in real estate. If it's less, then it doesn't make any sense. You can use your money and invest in stocks. It will be a much better investment play. The reason why it is like this, because there's so much uncertainty when it comes to real estate, that you want something obvious. And most of the work that goes into investing in real estate is finding that deal. That is what people don't get. People will see a guy making all this money. People will write books about it, about you got to get a property that 10xing this and 10xing that, and you got to get doors and all that good stuff. Most of the work in investing in real estate lies in finding the deal. And the deal you're trying to find is gross value of a gross cash on cash return of 15% or more. If it's not 15% or more, it doesn't make sense. So what I just told you, that the gross cash on cash return should be 15% or more. It sounds a bit unbelievable. It sounds hard to swallow, but it's the truth. Remember what I said in my intro. Rich people invest in real estate. Investing in real estate would not make you rich. A lot of the real estate that's available in Trinidad is basically mom and pop operations. They're trying to squeeze value out of their property, but the actual return isn't that great. So let's see. Let me prove the point I'm getting at. So let's have a look at this West Hills apartment. Remember this apartment? Remember what I told you? All you really need to know is two values: the sticker price, which in this case is 1.7 million, and the rental value. In this case is 8,000. So let's plug these values in the calculator and see what's our gross cash on cash. So we have 8,000 a month. So 8,000 by 12, 96,000 divided by 1,700,000. And what you get is a gross value of 5.6%. They will market this as a potential for for a good investment. They will market this as a good investment property. Nice gated community, nice area, 3 bedrooms. They will market this as a good investment property. But we just saw that the gross cash on cash is just 5.6%. That's the gross. So when you actually factor in and get your actual net cash on cash return, you may get something like 2%. In that case, why would I go borrow money from the bank to invest in this property, to struggle with tenants just to get not even 5, just to get less than 5.6%, when I could just go invest that into Trinidad and Tobago stocks and get a more or similar return? That's the key to investing in real estate. For this to be worth its while, let me see. For this to be worth being an investment property, I would need the monthly rent for this to be 21,250. That will give me a gross cash on cash return of 15%. So you can see it has to be obvious. It has to be an obvious deal to be able to invest in this property. So let's run 2 scenarios as if you were purchasing this West Hills apartment as an investment property. So we go to calculator.net and we go to a rental property calculator. So I'll blow this up on your screen so you see the values I use. So the purchase price was 1,700,000. The monthly rent was 8,000. Use a loan. In this case, we're going to do 2 scenarios. One where we use a loan from the bank, and the other scenario, we will just pay cash. And you will see for yourself what's your rate of return. So in this scenario, you use the loan from the bank. So Down payment 20%, interest rate 6%, which is less than a lot of places. Most places have 6 point something percent, but let's use 6% because I don't need to be extra conservative in these values because you'll see what the results are. Loan term, of course, is 30 years. Closing costs, I mean, I just put 6,000, but these closing costs could go as much as 20,000. But as I said, I don't need to pad these values that much because you'll see what the rate of return will be. So does the place need repairs? No, it's a brand new apartment, right? It's rent ready. Okay, so property tax, Kamla saying no property tax. I put that as 0. Total insurance, it's a nice place, so let's put it as 5,000 for the year. HOA fees, this is the homeowners association fee. These are the people who take care of the compound facilities. I put it at 1,500. I know places, most likely it's more than this, but let's leave it as 1,500 for the year. Maintenance, I put maintenance at 8,000 because this is what's called a high-end area. So any little thing that's not working properly, your tenants will complain. That's why the maintenance value, I just put 1 month rent, right, for the year as maintenance costs. Other costs, no other costs. Let's see what they have here. Okay, monthly rent, 8,000. All right. And vacancy rate 5%. I could put that as 0. Let's put it at 0. So for the entire duration, there were no vacancies. We always had a tenant in. Management fee, of course, 10%. And we spoke about management fee before. And the sell price. The sell price at the end of the 20 years, I'm going to sell this for 2 million. It really doesn't matter because you'll see. Maybe that's too less of a value. Maybe it should be more than this, but let's put it at 2 million. The cost to sell, I just put it at 8%. That's like all the legal fees associated with selling the property. You know, you need to pay your realtor. So yeah, let's see. Let's see what calculation it gives. And we get an overall IRR of 1.76% per year, which mostly came from the fact that you sold your property. Because if you look at the details table, you would see that the cash on cash return, this is the actual net cash on cash return, you're actually losing money. The reason is, let me focus on the reason. The reason is your mortgage payment far higher than the annual income from your rent. Let me say that again. The mortgage was higher than the rent. Because you see, in Trinidad, if you're paying a mortgage at 6%, for you to get a return on that investment, your rent has to be a much, much higher. So, yes, the renter is helping the landlord pay the mortgage, but the landlord still has to pony up some extra cash in order to just meet the mortgage. And that's just one expense. What about the other expenses? Yeah, we have the other expenses here in this sheet. So your cash flow is actually negative. That's why you get a negative cash on cash return. All right. So let's go to the other example. In the other example, you're not going to use a loan. So maybe this is the best case scenario. So you won't have that large operational costs of a monthly mortgage to pay. So we're just going to change there's no loan. You're paying this 1.7 all cash. Let's see what it says. So if you go all cash, you get a higher IRR, rate of return, at 4.47%. Yeah. At 4.47%, you get an cash on cash return of 4.21%. Because now there's no mortgage, you have these expenses. So the annual income from the rent can easily pay for the annual expenses. So you get a cash on cash return of 4.21%. But I just showed you before my portfolio, passive portfolio, currently making a dividend yield of over 5%. So if I have 1.7 million cash, is it better that I invest in a rental property or should I just invest in stocks? What do you think? If I invest in a rental property, not only do I have the hassle of dealing with tenants or dealing with a property manager or dealing with anything associated with maintaining the property, but I'm also making a lower rate, a lower return. So let me just play with some other value. Let's say we were able to double. Let's say we were able to double what we were going to pay, what we paid for the home. So that would be 3 million. Let's say we were able to sell it for 3 million. Then you, as you can see, the IRR is now 6.36% because most of the return is based on the fact that I was able to sell it for 3.4 million. The cash on cash return remains the same at 4.1 because that doesn't impact the expenses or the annual income. I was just able to sell the apartment at a higher price, double the price. So overall, it made the total return better. But even if this was the total return after 20 years, is that better than investing the money in a portfolio of stocks? No way. Remember what I said. Rich people invest into real estate. Real estate will not make you rich. So, going back to what I told you, let's say we were sticking to the rules I told you, and the gross cash on cash is 15%, at least 15%. So, for the gross cash on cash in this case to be 15%, that means the monthly rent will be 21,250. All right, so all the other values remain the same. Let me see if I want to edit something else. Okay, all the other values remain the same. Let's do the calculation. And the internal rate of return is 34.07%. And I get a cash on cash return of 33.86%. That's the riches people talk about when they say investing in real estate will make you into a millionaire. This is the type of opportunity you want. You want an investment property that's giving you that net cash on cash return of 33.86% if you follow the gross 15% rule. Now, I can put more stringent costs in place. So let's see. Let's say the closing cost was a more realistic 20,000. All right. Property tax. Yep, property tax is back. Put that property tax at 2,000. The HOA fee, let's make those HOA fee 3,000. Maintenance, let's make that maintenance 10,000 per year because these tenants will complain about every little thing. Management fee, all right. Oh yes, vacancy rate. Vacancy rate. Let's look at a vacancy rate of 10%. Not everybody, you're not gonna fill the apartment at all times. So I think these are some stringent values that I used. Let's see. I took a loan. Okay. Let's see. So loan, yes. So I'll have the monthly payments. Right. So let's calculate. So with the stringent values, we get an IRR of 25%, with your cash on cash return about 24%. So even with the stringent values, still getting 24% rate of return. And that's what you want. Because remember, when I showed you all my portfolio, my total portfolio, the dividend was 5.45%. But let's say we look at, let's say, Massey. Let's say you wanted to invest all your money in Massey that's currently yielding at, let's see what my Massey stocks is yielding at currently. Let me look for it while I'm talking about it. So my Massey stock, annual return 15.24%. So let's see, if I had to either invest in Massey and earn 15.24%, or invest in real estate and get 24.64%. That's the kind of assessment you want to do. And that's why this is in this case where your gross annual return is more than 15%. That's why that's the deciding factor in whether you divert your funds away from stocks and into real estate investment. Because if it's not obviously good, and when I say obviously good, I mean this value should be above 20,000 a month. So if you're going through these real estate sites and you see, wait a minute, the price of a place is 1.7 million and it can rent for 24 or 20,000 a month, that's obvious. That jumps out at you. And that's how you decide whether you're going to invest in real estate or not. Any other scenario, it wouldn't make sense. Don't even bother. Yes, we all get infatuated with the fact that you own something that you can see, touch, and feel. But at the end of the day, the maths does not lie. Don't fall for the hype. Rich people invest in real estate because they have the money, they have the dry powder for when they see an obvious investment opportunity, they can take advantage of it. It's not just because they invested in real estate that they're rich. So do not fall for the hype. Yes, real estate is a good avenue. Income generating real estate is a good avenue to invest in, but you have to have the right opportunity. So until that opportunity comes along, stocks is the way. So on a final note, there are scenarios where you can make this work. Maybe you were gifted some real estate, you were gifted land, so you didn't have to actually have to put out in buying a property and you decided to build. But the equation is still valid. The initial acquisition cost will be cost to build, whatever cost you had to build and to furnish that apartment, versus the income generated from that apartment. As long as that gross income divided by your initial cost is 15% or more, it will work. If it's not 15% or more, it's not going to work. And a lot of people find themselves in that position where they have very low yields, 5%, 4%, if they're lucky. And at the end of the day, when you're in that position, you have to just try to generate what cash flow you can, because it is not easy to just sell the property, right? If you look at any real estate website, you'll see a whole host of properties for sale. So your property will just be one of many. So if you already have the property, you're already in the hole that you dug. The only thing you can do is incrementally try to raise the rent as time goes by to help mitigate the fact that you're not generating much return. And then when that return that you're generating, I suggest you divert it into stocks. And that's what I do. And that's exactly what I do. The returns I generate, as I explained in an earlier video I uploaded on my channel, the returns I generate from my apartment, because I found myself in that same position. The apartment I have does not generate 15% or more gross cash on cash return. So that's the position I am. How do I mitigate the fact that I'm getting low returns? I take the rental income that I get and I invest on the Trinidad and Tobago stock market. The maths does not lie. This is not an emotional decision. This is a calculated decision. And those two values you can get upfront. If you want to know what price you can rent your real estate for, just look at what everyone else around you is renting for, because your property will be no different. And then you use the sticker price. 15% is your deciding factor. 15% or more, then you can go into the nuts and bolts of the deal. Less than 15%, you keep it moving and continue investing in stocks until another real estate opportunity comes around. As an example of how the real estate problem in Trinidad, what I found on Facebook recently is a repossessed house. And this happens when someone defaulted on their mortgage payments. So the bank repossesses the house. Now, what should happen and happens in the States and other countries is the bank should be selling this house for the difference between the equity that was paid already and the market value. But in this case, the bank is selling this repossessed house for 1.7 million. Now, I'm looking at the pictures and ain't no way that this house, where is it? This house is in Sandy Grande, Foster Road. Maybe it's close to the new highway, who knows? But there's no way the difference between the market value and the equity in the house is 1.7 million. But it is what it is. And if that's the value of the house, just so happens to be 1.7 million, then we know for this to be a good deal to invest in, then the monthly rental that you should be able to get for purchasing this house is around 20,000. No one is going to rent a house in Sandy Grande for 20,000, even though it's 7 bedrooms. So, if you like what you heard in this video, I know some of you were excited about investing in real estate. I hope you get that gross cash on cash return to be 15% or more, because if it's not worth it. If you like what you heard in this video, hit a like and subscribe, and let's spread the knowledge. Thank you.